Good day, ladies and gentlemen, and welcome to our class on the best multi-indicator trading strategy. I would appreciate greatly if you could hit the subscribe button and subscribe to my YouTube channel. And also, please watch our other videos, and you're welcome to comment. I appreciate any interaction. Thank you very much. So please like and comment, share, and also subscribe. So let's get started with the best multi-indicator trading strategy for Forex, CFDs, crypto, shares, gold, and oil. Now, many investors and active traders use technical trading indicators to help identify high probability trade entries and exit points. Hundreds of indicators are available on most trading platforms. Therefore, it's easy to use many indicators or to use them inefficiently. Now, I'm not going to go in today to how to set up indicators, what indicators are. We're not going to go over a great deal because that's whole separate classes. Okay, we're going to talk about the indicators we're going to use to build this strategy. Because keep in mind, first you want to only test individual indicators and then try to combine them together. Keep your technical indicators as simple as possible to avoid repetition. When selecting pairs, pick one leading indicator and one lagging indicator. Consider multiple indicators to help identify false signals and analyze and track indicators' performance over time and refine as necessary. So to find the best technical indicator for your short-term trading approach, test out a bunch of them singly and then in combination. You may end up sticking with, say, 4 that are evergreen, or you may switch one off depending on the assets you're trading or the market conditions of the day. Regardless of whether you're trading stocks, forex, or futures, it's often best to keep it simple. I subscribe to the KISS strategy. Keep it simple, stupid. KISS. Make everything as easy as possible. Don't overcomplicate anything because you're not going to find any edge, anything better. Okay? Because strategies help you enter the market, help you set your stop losses, help you take profits. But it's ultimately risk management, experience, and know-how. It's minimizing your risk while maximizing your profits. Now, keep in mind that indicators, they only indicate. They're derivatives of the market, and almost every, in fact, off the top of my head, I don't know a single one, but I'm sure there is somewhere, use the open, the high, the low, or the close, or volume. So they're all based on the same mathematical numbers. And depending on the mathematical formula that they apply to or how they're set up, they are either trend indicators, momentum indicators, volume indicators, or volatility indicators. It's important to understand what the difference is. Okay, and we'll come to that as we build this little trading strategy. Trend indicators tell you which direction the market is moving in, and if there's a trend at all. They're sometimes called oscillators. Now we have momentum indicators that tell us how strong the trend is and can also tell you if a reversal is going to occur. Then we have volume indicators. Volume indicators tell you how volume is changing over time, how many units of Bitcoin are being bought or sold over time, how many shares of Apple are moving, how many contracts of gold or oil. Now, volatility indicators tell you how much the price is changing in a given period. Volatility is a very important part of the markets. The higher the volatility is, the faster a price is changing. It tells you nothing about direction, just the range of prices. So why are indicators so important? Well, let's back up a little. I am a price action trader. I very rarely use indicators. I use support and resistance, chart patterns, and my candlesticks. But sometimes I need a little help. I can't finally interpret what the markets are telling me, and I might use an indicator. Other people trade from their charts and a set of indicators, looking for the indicators to do something together to give them that alert or that buy or sell, or even help you put stop losses and take profit points. So it all depends on who you are and your personality. As a trader, it's your job to understand where the market might go and be prepared for the eventuality. Now, when we're using indicators, we want to avoid this great big statistical term, multicollinearity. It's a statistical term that refers to the multiple counting of the same information. This is a common problem in technical analysis that occurs when the same type of indicators are applied to one chart. Sometimes I have traders coming to me all the time, not something, a lot, tell me they're using RSI, stochastics, and MACD. And I kind of look at them and say, why? They're all telling you the same thing. How do you interpret when you're using the same data the same way to get this and getting the same results? So this creates redundant signals that can be very misleading. Some traders intentionally apply multiple indicators of the same type in the hopes of finding confirmation for an expected price move. In reality, however, multicollinearity can make other variables appear less important and can make it difficult to accurately evaluate market conditions. To avoid the problem associated with multicollinearity, traders should select indicators that work well with or complement each other without providing redundant results. This can be achieved by applying different types of indicators to your chart. Don't worry, we're getting there. A trader could use one momentum and one trade indicator. For example, a stochastics oscillator, an ADI or ADX indicator, a trend indicator, and chart with both applied. Since each provides a different interpretation of market conditions, one may be used to confirm the other. It's up to each trader to decide which technical indicator to use, as well as determine how best to use the indicator. Now, I'm not going to spend any time on it, but you also have the ability to use variable inputs or user-defined inputs. You can change your numbers on your stochastics to be 80-20. You can change your Bollinger Bands from being 2 standard deviations to 2 1/4 or 2 1/2 standard deviations. Sometimes this helps, especially in different markets. But before you do that, you need to understand what you're doing. Because today's advanced platforms allow us to optimize all the studies. So if you trade with a multi-indicator strategy that uses RSI indicator, MACD indicator, and stochastics indicator, you are basically using 3 types of technical indicators that belong in the same category. So in other words, you've got multicollinearity, and if you notice on the chart, they're all telling you to do the same thing at the same time because they're all, and they will always or almost always be identically the same. Here, you see on my chart here, this was a live chart an hour or 2 ago. And you can see where all 3 indicators are giving you the same results. Now there are 3 momentum indicators that are going to, these are all momentum indicators that are going to display for you the same kind of information one way or another. That is not good. So the best strategy for multiple indicators. Okay, here we go. We're ready to build one now. Now here comes the fun part. We're going to use a momentum indicator, a trend following indicator, and a volume indicator that support and complement each other. We're not going to spend any time explaining how these really work because just to understand RSI, I have a whole 1-hour class. Okay, so if you don't understand RSI, you need to learn about it. But for this process, first of all you do is go to your charts and click on RSI. It's going to drop it on there. And since it's all automated for this process, you don't need much other information. So the relative strength index is a momentum indicator and is a leading indicator at the same time. A lot of traders like the RSI indicator because it's easy to use. It drops on our chart below price and it fluctuates in what we call a bounded oscillator. It will always come out between 0 and 100. It then has ranges of 70 and 30 that in between are like ignoring zone, and above and below give us overbought and oversold zones. We use RSI to indicate possible overbought and oversold market conditions. Now let's go on and mention our second indicator. And we're going to add to that today OBV, our volume indicator, on balance volume. And it's based on the idea that both the volume and the price activity are equally important. In this regard, the OBV combines both price and volume to show you the total amount of funds going in and out of the market. So OBV drops on our chart directly under our RSI. Okay. So, and we do this also by clicking on the button on our charts under indicator, and we do it. So the main idea between on balance volume indicator is that the market price will follow where the volume flow is going. Now all we've got to do is to name our last technical indicator, and that will complete our multiple indicator strategy. And for that, we're going to use Bollinger Bands. Bollinger Bands is a trend following indicator. It also helps us see volatility in the markets, and it gives us other pieces of information. Buying and selling based on Bollinger Bands can be very effective trading strategy, especially if used in combination with other technical indicators. So here we've dropped our OBV on the bottom of the chart. We have our RSI on the bottom of our chart, and Bollinger Bands drops over top of price. So now we have the three indicators on our charts. We haven't made any assumptions yet. We just have the three indicators on our charts. So finally, your chart should look like the chart that we just saw. Okay. Now, Bollinger Bands, so like I said, is a trend following indicator. Without further ado, let's show how you can efficiently trade using multiple technical indicators and how to make consistent profits the smart way. For our strategy, we will use the three indicators in order to successfully trade. These indicators will include RSI, Bollinger Bands, and OBV. Collectively, these indicators account for the trend, the momentum, and the volume aspects of trading that a trader should pay close attention to. So how do we start? Well, we have them on our charts. Our charts are set up. Okay, now, price needs to break or close above the middle of the Bollinger Band. Okay. I'll show you that in a second. Because Bollinger Band has a 20-period moving average in the center. Above the top line is a 2 standard deviation. Below is a -2 standard deviation. Okay. We need price to break that moving average line in the center and move above the middle. We could say the exact opposite if it falls below the center because we're looking at short or long. So the first confirmation we need is for the price to break and close above the middle Bollinger Band. Once this trade condition is verified, we can check the other indicators for adding more confluence to our trade. We haven't made any decisions yet. We're just observing. So here we can see we have the Bollinger Bands on our chart. We have our 20-period standard moving average, which is the basis of the calculation of Bollinger Bands. And when price moves above the moving average, not when it's sitting on it, not when it's below, when it moves above, not when it's hanging above, it's when it was below and moved through, or the opposite is true for the downtrend. So now let's see what the RSI indicator starts telling us at the same time. So we wait for the RSI indicator to trade above the 50 level if it doesn't already. Using an RSI reading above the 50 level is considered as a positive momentum, while the RSI reading below 50 is considered a negative momentum. Now we're only looking at momentum. We're not looking at overbought and oversold. We're only looking at momentum. So we're looking for a buy. We need our momentum to be above the 50 reading, which is the center because it goes from 0 to 100. So here we can see on our chart below, our Bollinger Band has moved above our 20-period moving average. Our RSI breaks above the 50 level, which is the center between the 0 and 100. So we now have two indicators working together, but so far we don't have a story to tell. Now, not all the time you'll see RSI breaking above 50 level at the same time as price breaks above the middle Bollinger Band. Sometimes we might need to wait longer for the bullish momentum to show up. Then 3, we're going to wait for the OBV indicator to rise. Buy at the market once you see the volume confirming the price. The last trade condition before pulling the trigger is to, again, easy to understand. We want to trade on the side with the smart money. In this regard, we want to look for evidence that the trade we want to take has real buying power behind it. We can notice that the real volume only showed up later. It's important to have patience and wait for us to see this. Okay. So we see the volume increase showed up behind the Bollinger Bands and the RSI. Not much behind, but showed up behind. So again here, we have Bollinger Bands breaking above the 50, the 20 period moving average, RSI breaking above the 50, and we see the climb now in the OBV. Okay, now we're ready for a buy scenario. The next important thing we need to establish for our scalping trading is where to place our protective stop loss. Because keep in mind, we're now getting a confirmed buy. We still have to use our risk management risk reward ratio. When we figure out where we're going to put our stop loss and our target point, we can then determine if we can even afford to take this trade. So we want to hide our protective stop loss below the lower Bollinger Band. Know where to place your stop loss is important, knowing when to enter the market. The logical place to hide your protective stop loss is below the lower Bollinger Band. A break below the lower Bollinger Band will invalidate our trade idea, and we want to maximize or minimize our losses. Okay, so here we have our Bollinger Band, our RSI, and our OBV. Our stop loss would be right below the lower part of the band of the Bollinger Bands. Okay, our entry point would be the break back above this 20 period moving average here, because we saw this is where we got our buy signal. We saw it riding the band. It came back down and it tested that 20 period moving average, and once it bounced off of there and continued up, that would give us our buy. So we have our buy, our stop loss. Okay, what else do we need? Last but not least, we also need to find our take profit level of our multi-indicator trading, which brings us to the last step. Our take profit when price breaks below the lower Bollinger Band. Okay, our take profit strategy only looks at one indicator to signal us a possible exit zone. If we wait for confirmation from multiple indicators, then we might as well give back some of our profits. In this regard, the best way to take profits is when we see the price reversing. A break below the lower Bollinger Band is a good signal for a possible reversal. So we want to cash out our profits at that point. So here we go. We have our Bollinger Band breaking above 50. It's confirmed by above the 20 period moving average. We have our RSI breaking above 50. We have our OBV starting to rise. Then we look for so we now have a buy alert. Okay, we know we're going to buy. Now we look for the entry to the market to buy here. And we would put our take profit point somewhere down here as soon as it breaks that Bollinger Band, okay, or it breaks below the moving average of the Bollinger Band and starts to move away. Okay, we also have our resistance level here, and that's what we would use to set our potential target point so that we could calculate our risk reward ratio. So the above is an example of a buy trade using multiple technical indicators. The same rule applies for sell, just in reverse. So just flip everything over for a sell alert. We choose these indicators because as a group, They can help protect you from each other's weakness while also maintaining each other's strength and integrity. For these indicators ever, if these indicators ever give contradicting buy and sell signals, something that does occasionally happen, it will be up to you to decide if you are willing to open a riskier position. If they're giving you, if they're not giving you exactly what they should be, go away. There's going to be another trade to be had somewhere else. Always look for only high probability trades. So on the other hand, when each of these indicators confirm the signal being sent from the others, you can be much more confident with your trades. So if you follow our best combination of technical indicators, you can improve your chances of winning more often than losing trading in the market. You must keep in mind that all indicators are based on past price, so only a multi-indicator strategy can help you predict the future. And that's all today, folks. Thank you very much for joining us. I hope you learned a little and try out our strategy. Add some things onto it. Maybe look at price add support and resistance look at trend lines. Look at price action. But it's an easy strategy for you to set up and start trading without spending years learning about each of these indicators.